Welcome back to Talk Tickers. It is Saturday, January 31st, 2026. If you're tuning in, you're not looking for the flashing headlines you saw yesterday. You are looking for the signal in the noise.
Exactly.
Today, we are cracking open the books on Murphy Oil, ticker symbol MUR. They just dropped their Q4 2025 earnings, and looking at the reaction, we have a lot to unpack.
We certainly do. It was a messy one. This is one of those classic quarters where if you only look at the bottom line, the EPS, you might think, hey, everything's great.
A screaming buy, maybe?
Right. But then you look at the price action, the volume, the guidance, and you start to see why the market is having a serious case of indigestion right now.
Okay, so let's set that scene. Murphy Oil reports. They beat earnings per share estimates, and pretty significantly. So what does the stock do?
It drops.
It drops. Pre-market, it was down almost 3%. It clawed back a bit, but still closed the day down about 1% at $31.08.
And the volume, that's what really caught my eye, a massive spike. We saw 6.5 million shares trade hands.
And their average is what, about 4.5 million?
Exactly. So that's a huge increase. This isn't just noise, you know.
So not just day traders messing around on an app because they saw a number they liked or didn't like.
No, absolutely not. When you see a volume spike of that magnitude on a down day, especially after an earnings beat, that tells you institutions are repositioning. The big money is rotating out. They found something they really didn't like.
It's the classic mixed quality beat, great bottom line, messy top line, and a whole lot of trust us about the future. So let's get into the actual numbers. What happened?
Okay, the headlines. The what? Earnings per share came in at $0.14. Now, the consensus expectation was a loss of 2 cents.
A loss of 2 cents. So they didn't just beat, they crushed it.
They crushed it by 16 cents. In a vacuum, that usually sends a stock soaring, right? You go from expected loss to a solid profit.
Yeah.
That's a huge green candle on the chart.
Usually.
But then you look at the revenue. They brought in $613 million. The street was looking for $641 million.
So a $28 million miss, and that's down year over year.
Down nearly 8.5%. So right away, you've got that friction. Profitability is better than expected. Sure, maybe they cut costs, but the top line growth just isn't there.
That's a red flag.
It is, but honestly, the revenue miss isn't even what spooked the market. That happens. It's oil and gas. The real anxiety, the reason for that volume spike, it came from the guidance.
The future. This is where the narrative shifts from past performance to future pain.
It was a structural reset. So Murphy released their 2026 production guidance. They're looking at between 167 and 175,000 barrels of oil equivalent per day. Let's just call the midpoint 171.
Okay, and for context, what did they do in 2025, the year that just finished?
In 2025, they produced 182,000 barrels per day.
So they are looking the market in the eye and saying, hey, next year, we are going to shrink.
Precisely. They are shrinking production. Now, if they were shrinking production to save money, to cut capex and return cash, Wall Street might love that.
Harvest strategy, the value play.
But here's the kicker.
Yeah.
They aren't shrinking the checkbook.
I'm looking at the capex guidance here, $1.2 to $1.3 billion. That seems high.
It is high. So you combine those 2 points. Shrinking production volumes, heavy capital spend. That's the worst of both worlds for a momentum trader.
You're paying more to get less.
That's a difficult pill to swallow. Management is framing this as a transitional year. That was the buzzword.
Yeah.
But what does that actually mean?
Is that code for we have a problem?
Not necessarily a problem, but it's the invest now, harvest later defense. But we need to dig into why production is dropping, because it's not what you think. It's actually a very technical situation up in Canada.
Right. The Tupper Montney asset, I read the notes on this and I had to read it twice. It has to do with gas prices and royalties. Can you break this down simply?
Yeah, it's tricky, so let's walk through it. Murphy has this big gas asset in Canada, and the deal they have with the government is a royalty rate on a sliding scale.
Like a tax bracket.
Similar concept. It's tied to the price of gas. Gas prices are low, the government takes a small cut. Gas prices go up.
The government wants a bigger slice of the pie. And gas prices are forecast to be higher in 2026.
Right. So in 2025, the royalty was about 4.6%. For 2026, it's jumping to roughly 8.4%.
That's nearly double.
It is. Now, here's the key part. That royalty is paid in volume. It reduces the net production Murphy reports.
Wait. So if they pull 100 units of gas out of the ground?
In 2025, they got to keep about 95 of them. In 2026, they only get to keep 91. The actual wells are flowing the same amount of gas out of the earth.
The geology hasn't changed.
Nothing has changed. But the accounting changes because the government is taking more barrels off the top.
So the headline number looks like a decline, but the actual cash flow might be fine because the price is higher.
That's the irony. They might make more money on it. But an algorithm just sees production down and hits the sell button. It creates this noise.
And patience is in short supply. The CEO, he spent a lot of time talking about the balance sheet, flexibility. He knows the market is nervous.
He definitely sensed the tension. He was careful to say the spending is discretionary. He said if oil prices crash, they can cut capex by about 10% in 2026.
10% isn't huge.
No, but he said in 2027, they could slash it by 30 to 40%. That's the emergency brake.
A pretty big break.
It is. But he also drew a line. The must-do projects, the things they will not cut. And that list is the future of this company. Vietnam and the Chinook well in the Gulf.
Okay, let's pivot to Vietnam. Because if you're a bull on this stock, this is the hill you're dying on.
This was the most exciting part of the call. We're talking about the Q Long Basin, and we have real numbers now from the appraisal well.
The Golden Sea Lion, Hai Spong, they ran a test, and the results were, describe them.
They were massive. They tested the well, unconstrained, at 12,000 barrels per day.
Put that in context for us. Is 12,000 good? Great?
It is exceptional. In that basin, a typical well is maybe 2,000 barrels per day, so this is flowing 6 times the average. It speaks to incredible reservoir quality.
Yeah.
And get this, they found 429 feet of net oil pay, and they didn't even hit the oil-water contact.
Explain that. What does that mean, the oil-water contact?
It means they drilled down through the oil, stopped drilling, and there was still more oil below them. They don't even know how deep the pool goes yet.
That sounds massive.
It is. And management made a very bold claim. They said by the early 2030s, this Vietnam business could be larger than their entire Eagle Ford shale operation is today.
That's a huge statement. The Eagle Ford is their cash cow.
It's like saying your side hustle is going to replace your salary. But the timeline is the problem, isn't it?
The stock market is impatient.
The transitional pain. They have another project, Lackaban, the Golden Camel. That gets first oil in Q4 of 2026. That's near term. But the monster, the Golden Sea Lion, first oil isn't until 2031.
2031? That's a lifetime in financial markets.
It is. And the market is discounting that 2031 oil to almost zero today. Investors are looking at the cash burn now and saying, show me the money today.
But surely they have something keeping the lights on. Let's go back to the Gulf of America. Their bread and butter.
It's a battle against decline. This is what investors worry about. The base decline rate in their Gulf assets is about 18% annually.
18%. So if they do nothing, they lose nearly a fifth of their production every single year.
Correct. They have to spend that huge capex number just to stand still. The big bridge for them is the Chinook well.
Comes online in the second half of this year, 2026.
Right. They call this zero risk.
Yeah.
It's replacing an old producer. They need this well to work to exit 2026 with any momentum.
Okay, but we have to talk about the ouch moment of the call. Côte d'Ivoire, the Sevet well.
The dry hole.
They drilled and they found nothing.
Non-commercial oil. It happens. It's the nature of exploration. Management spun it well, saying the other prospects are independent plays, so this doesn't mean they'll fail.
Geologically true, but it's psychologically damaging, isn't it?
It is. You're asking for patience and capital, and you start with a dry hole. It highlights the risk.
But they're not stopping. They announced a new entry into Morocco. Is this smart?
This is the lottery ticket. It's very low cost, about $5 million over 3 years. For them, that's a rounding error. But it's a massive, untested structure with amazing fiscal terms because Morocco doesn't produce oil yet.
Low risk, high reward, but again, years away.
Exactly. It fits the theme. Everything exciting is 3 to 5 years out. Everything painful is happening right now.
So let's connect the dots. Beat on EPS, miss on revenue, guide down on production. Why did the stock sell off so hard?
It's about trajectory. The EPS beat is the rearview mirror. The market looks through the windshield, and the windshield shows a dip in 2026. Investors hate negative momentum.
It's a show me story.
The stock is in a waiting room until Chinook and Lackaban start flowing in the second half of the year. Until then, there's no real catalyst.
And the macro environment isn't helping. Crude has been volatile.
Right. When oil is choppy, investors want safety. They want companies with massive free cash flow today. Murphy is saying, we're going to take that cash and bury it in Vietnam so we can be rich in 23.
It's a growth strategy in a market that wants value.
A total mismatch with the current mood.
Which brings us to my favorite part of the deep dive. We've looked at the numbers, we've heard the story. Let's get creative.
It is time for the This Is Not Financial Advice segment.
Disclaimer time! We are not your financial advisors. Do not trade based on what we say. We are just exploring Plausible scenarios from the data.
Wild scenarios.
Okay, what's the pitch?
I'm calling it the Vietnam time arbitrage.
I like it. Break it down.
The market is pricing Murphy like a decaying Gulf of Mexico producer. They're assigning almost zero value to the Vietnam success.
Ignoring the 12,000 barrel per day test.
Completely. So the trade is a pair trade. You go long Murphy, MUR, but you hedge the oil price risk. So you need a short.
What are you short?
A pure play shale peer. Specifically, one that's running out of Tier 1 inventory.
Explain that Tier 1 inventory. Why is that the key?
Sure. In shale, Tier 1 is the prime rock, the sweet spots. A lot of U.S. companies have drilled up their best spots. Now they're moving to Tier 2 rock.
Which is not as good.
Not nearly.
Nah.
The wells are less productive, more expensive. Their capital efficiency is crashing.
Costs up, output down, a slow bleed.
Exactly. So you short the company whose rock is getting worse, and you long Murphy, who just found massive new rock. You're betting on geology.
But you have to weigh it.
That's the arbitrage. You're buying the patience the market doesn't have. Or, if you want the high-octane version,
Here we go.
you look at EPS, long-term equity options. You look out to late 2027.
Why late 2027?
That's when the final investment decision on Golden Sea Line happens. That's when the market will be forced to mathematically value those reserves.
And right now?
Right now, you can buy those options for pennies on the dollar because everyone is freaking out about gas royalties in Canada. You're buying the catalyst announcement 2 years early while it's on sale.
That is spicy. It requires a stomach of steel.
It's an outrageous play. But if that Vietnam field is truly bigger than the Eagle Ford, the re-rate would be violent.
Violent upside. I love it. Again, not financial advice. So let's wrap this up. Final takeaway.
Murphy is asking for a gap year. They're taking 2026 off from the growth race to reset the foundation.
Yeah.
It requires a lot of trust.
And they're betting that 2030 will make 2026 look like a blip on the radar.
The question is, does the buy side have the stomach to wait for 2031 oil in a 2026 market? Based on yesterday's price, the answer right now is no.
And that's often where the opportunity lives.
Exactly.
That's a wrap for this deep dive. Thanks for listening to Talk Tickers. Check the disclaimers, do your own research, and we'll catch you on the next print.
Stay curious.